news time on Equity Access, your aerial perspective on stock market developments and on developments in the Zimbabwean economy. A splendid evening it is to you. I'm Ibn Mabunda. Let's get started. Our stories tonight: JSE listed clothing manufacturer as well as retailer Edcon, with a controlling stake in Edgar Zimbabwe, has secured an investment worth $191 million in cash as well as rentals reduction. Well, the firm, of course, has been grappling with credit issues for several years. After in 2014, it suffered from credit issues as well as that coinciding with economic slowdown and a weaker consumer spending. In January, Edcon Chief Executive Grant Peterson said that the organization needed capitalization worth $226 million in order to stay operable over the next few years. Edcon has a 38% stake in Edgar Zimbabwe. Well, recently, January to be specific, that shareholding was increased to 41% in a transaction that saw an exchange of 15 million shares worth $1.5 million in return for rights in Jet as well as Edgar's brands here in Zimbabwe. The move, of course, is expected to reduce Edgar's costs, which they have incurred over the years associated with paying for franchise fees for Jet as well as Edgar's brands. In a statement issued on January 22, 2019, EDL Secretary Buhle Mpofu said that the resolution was passed and now awaits exchange control approval from the Reserve Bank of Zimbabwe. Meanwhile, the Parliamentary Committee on Public Accounts today convened with the Central Bank Governor, Dr. John Mangunjika, being quizzed on key issues to do with the operations of the central bank. Well, of note was the subject of Zamco, which is the Zimbabwe Asset Management Company. Zamco was established in 2014 with a 10-year mandate to rid the banking sector of all non-performing loans. It has since acquired debt worth over $1 billion from stressed companies with the potential to be rehabilitated upon the injection of fresh capital. It mobilized treasury bills for banks to get liquidity and has been converting NPLs, which are non-performing loans, into performing loans by debt restructuring, among other strategies. Dr. Mangunjika defended Zamco. Let's have a listen.
Zamco has done very well for this economy. Without Zamco, Mr. Chairman, without Zamco, we should always ask ourselves, what could have happened to Zimbabwe's economy without Zamco? I can put to your chairman and the members of parliament, the Senate, but without the Zamco, this economy could have collapsed. Why am I saying that?
It's not a few shares,
I said in the Reserve Bank position, which is shared by those who are willing to share, that's the like-minded group. If you look at the page 12, Chairman, page 12, you see at the end, I've just given you a few companies, for example. If you look at the staff, if you look at the Rio Zim, where would the gold that comes from Rio Zim or the diamond that are being done to diamond, was those people would have all been fired? If you look at all the Rengo mines, Kemon Moda, they are producing gold to the value of more than 250 kgs per month. It means that we are saying those ones who share that position, maybe it's because we are not been communicating. That's why we are happy, Chairman, that we are.
Well, that's Dr. Mangunjika's position with regards to Zamco. However, according to the record, that shows that the Professor Mthuli Ncube, who is the Minister of Finance, has a different opinion with regards to the operation of Zamco. Let's have a listen.
And I think the Minister of Finance shares that view, because in paragraph 107 of the budget statement, his statement of the 22nd of November, he says in paragraph 107, in the same vein, government is freezing treasury bill issuances related to Zamco operations. With immediate effect, Zamco will no longer assume further loans from the market. In addition, government will review Zamco's mandate and consider winding up of its operations, which are being supported by government. So,
to review these issues, I'm joined in studio by our resident chief analyst, Respect Quincy. Respect, good evening and welcome to the show.
Thank you. My pleasure, Ivan.
Splendid. Glad to have you back. Beautiful. Let's get the ball rolling. Edgar's receiving a bailout of $191 million. Should I say a capitalization of $191 million. Quite a huge sigh of relief for Grant Patterson right there.
Sure. This company has been struggling lately. A lot of debt issues, failure to repay its creditors, and it has been weighing on the giant. So I think this capital injection might go a long way into restructuring the company. Of course, it will have a significant impact on the shareholding structure, depending on the nature of the cash flow. If it is debt equity, then definitely it won't affect the if it's debt capital, then it won't affect the equity positions. But what I believe is that it's set to impact on the operations more positively, and it allays the fears of a total complete breakdown of the group.
Yeah, I think this comes as a positive, very much so. You mentioned something to do with the kind of injection this is. Of course, we've got pension funds, the UIF coming in there, and then we've also got a reduction in terms of the rentals that they're due to pay. Previously, we did receive news to the effect that they had engaged their landlords to try and have some kind of a restructuring so that they could, reduce their their payments. So I think that comes definitely as a positive in that regard.
Yeah. So the arrangement with landlord was usually to either convert part of the debt into equity, which means if we owe a rental arrears to the tune of 2 million, then we might have to then either convert that into a proportional equity of sort. And they were also looking for a big fund in terms of the asset managers in SA to push in capital, and I'm sure they've attracted the right kind of capital, long-term money, which usually is not so quick to demand some return. So it allows them a breathing space to properly restructure. So I think it's a big positive for Edcon, and also for the local subsidiary
Edgar's.
In terms of Edgar's Zimbabwe. I think it's a relief. Recently, Edcon, in fact, Edgar's acquired the rights to own the Edgar's brand directly from Edcon, but in turn they paid for it in terms of equity. So they swapped the rights acquisition by giving Edcon additional shares in the respective local company. So that spells a good brighter future, because if you have a local brand which is also represented regionally, it puts brand equity on a better stead in terms of Edgar's, and it also brings instability on the shareholder side. Just to know that you have one shareholder who is not changing in a very short space of time, it brings stability to the local operation as well.
Talking about stability where the operations are concerned, a few years back they were grappling with the debt with $2.1 million for the franchise rights in Jet as well as Edgar's, of course, alongside other brands.
Sure.
So now that they've engaged in that kind of a deal as of January to actually own these brands locally, that should actually spell a positive in terms of their operations going forward. They won't have to worry about the debt and things like that. But of particular interest is that while the shareholders have passed this deal, or while there's been a deal brokered between Edgar's and Edgar's Zimbabwe for the increase of that shareholding from 38% to 41%, of note was a statement by Buhle, who's the company secretary, who said that, look, this is subject to approval by the central bank in terms of their controls. Do you think that that they're going to succeed in that regard, or that will sail through given what's actually happening with our forex issues?
Yeah, the issue with exchange control, rather, it's in better state for RBZ to accept such a proposal. Why? Because there is no capital outflow. If Edgar's Zimbabwe was to pay directly to Edcon, it means these guys would have to push out money. And this money is RTGS money being converted into US dollars or South African rand. So RBZ would have to convert Edgar's RTGS into Forex in order to settle that amount. Rather, this debt has been converted to equity, which means instead of pushing out capital, rather we are saying the debt is being replaced by additional shareholding in the local unit. So there's no movement of cash.
Okay.
So it actually relieves the RBZ.
All right.
Because if they were to pay, it means they would have to ask RBZ to release part of their funds. And given the cash deficit in the economy, it means they will be on the receiving end. So I see the RBZ easily pushing through the resolution according to the latest AGM results.
Okay, and with Edcon getting to sort of resolve their issues, that would definitely spell a positive, because you wouldn't want to have a change in terms of ownership, at a point like this, with what's actually playing out in the Zimbabwean economy.
Yeah, I think I definitely agree. But as a player in the retail space, in the apparel retail space, there's been intense competition, and the terrain remains critically subdued. Locally, demand is going down, especially in the current year. It's likely that demand will definitely be coming off. So we are likely to see those top line growth as experienced in the past years in all retail. You would recall that Truworths actually highlighted that they had some very huge growth numbers in 2018. Same as Edgar's as well, but the terrain in Zimbabwe is slightly shifting, and there might be that kind of shake in the apparel retail space.
Yeah, I recall Truworths CEOs explaining how they were experiencing problems restocking for
October going forward.
Yes, so I think with that said, it would be interesting to see how the story actually plays out, given what's playing out in the economy.
Sure, I agree.
Moving on to the next issue, a parliamentary committee on public accounts, and the interesting thing is that it's being headed by former Minister of Finance.
Yeah, interesting indeed.
Honorable Tendai Biti. Well, core to the discussion there was the Zamco issue. It's apparent that Zamco has acquired debt over $1 billion from stressed companies with the potential of being rehabilitated upon the injection of fresh capital. But the question is, how successful has this operation been? How successful has Zamco been? And could Zimbabwe have made it without Zamco?
So Zamco was created for the purpose of cleaning out the banking sector, cleansing the banking sector of bad debts. So bad debts, this is money that would have fallen due beyond a certain period and is now deemed irrecoverable. So most loans had gone bad, which means they were irrecoverable. And there were some companies which were also failing to repay their debt as well. So the list includes Star Africa, Rio Zim, and so many other companies that were bailed out. In other words, what the government did was to acquire debt due from these companies. So in other words, they are saying, we know Star Africa, you own cabs. So we are now buying your debt from cabs, such that you no longer have debt, but you now have debt to us. So we will extend your debt into an 8-year term.
Okay.
It's now due to us. You repay it in such a way. So the terms are now more favorable. The timelines to pay are also lengthened. And you receive possibly also an immediate cash flow injection. So that was the purpose of Zamco. And the way they paid for this debt was by issuing treasury bills. So banks were being given treasury bills to counter or to settle the debts that banks were owed by some of these companies. So this is the background against which Zamco, which means the Zimbabwe Asset Management Company, was created. So they acquired amounts over $1 billion, slightly over $1 billion, up until it was wound up in mid of 2018. And by that time, if you look at the loan structure of Zimbabwe, the total loans were slightly above 4 billion. And of that, it means 1 billion, which is about 25%, was actually bad debt.
Okay.
But if you look at the NPL ratio at the time upon which Zamco began to acquire loans, the ratio was at about 20%. So I think the question really here is to ask ourselves whether it was prudent for government to assume the debt at that point and what consequence it had.
Yeah, because I'm very much concerned about the repayment of this credit, because the moment that we talk about credit, it means we have created a deficit elsewhere, and that deficit needs to be taken care of. So now that government has acquired that debt, I'm not convinced about the rate of payment, or the debt is still there. It's still very much at large and is yet to be addressed. So in terms of the success, no wonder Professor Mtuli Ncube has argued that, look, this thing has been toxic. What would be your take where that is concerned?
I do beg to differ in a way. This is a standard world over. I'm sure in the governor's presentation he tried to highlight some of the... In fact, it's true of every economy. If you look at Edcon today, in South Africa's budget, they actually budgeted to bail out Edcon, which is the provider of electricity in South Africa. So I don't think it's much to do a matter of as in whether government should have done it or not. But in any such endeavors, there should always be a cost-benefit analysis. You have to look at the probability of payback, the probability of the company to pay back. And I'm sure Zamco had structures in place to evaluate the nature of the company at hand. If it's Star Africa, it's a sugar-producing company. Is there market for it? Then you realize that the way the market is made, you have to do a proper analysis. If they're competing with Hippo, what a fraction of the market does this ailing company have or can take if it's bailed out? So I think there was a bit of some evaluation around those things. And if you look at a company like Star Africa's numbers lately, they've been able to refurbish the primary plant in Harare. They've been able to increase production. They've been able to restructure loans. They've been able to report an operating profit position. And if you look at Riozim and some of those companies, there is a genuine tendency towards recovery. And as rightfully as the governor said, there's also a cost involved in letting those companies sink, jobs and so forth. But anyway, you cannot save a job if a company is you don't only intend to save jobs. The primary thing is to achieve a profit position. So if a company can produce a profit position, then of course you might want to save jobs. You can't just save jobs and let the company.
Concern then this would be to do with the sustainability. How sustainable can we continue to run this vehicle that we have so called Zamco? Of course, yes, there's been that winding up, but of concern would be the sustainability, because I'm saying Zimbabwe is grappling with a debt, $10 billion in domestic debt. That's before we talk about what we actually owe outside Zimbabwe.
So I think that's a very paramount question. Whenever debt is issued, it should be issued for productive purposes. What am I trying to say? Government issued treasury bills since 2014, which now amounts to 7-point-something billion, right? There's a fraction of that debt which went to productive purposes. If you lend to produce and the production actually pays back, or the production actually gets to be profitable, there's no problem with that. The problem that we are having in terms of treasury bills is not to do with funding that went to companies. It's funding that went to recurrent expenditure. Funding that was pulled by government in order for it to pay civil servants, to pay unproductive farmers. That's where the problem is. But then we ended up lumping everything. The problem with the committee today was you created a fiscal deficit by issuing treasury bills where when you were funding some of these companies. But it's not all debt that is toxic. That's my point here. If you issue a treasury bill which attracts an interest of 7% per annum, and you also tend to get a return of, say, 10% from your debt that you have assumed, that you have covered for on the next person, it means on the net you are on the positive. If you're saying, Star Africa, I am giving you a debt relief, or I'm buying your debt, but you have to pay back this amount in 8 years at 10%, and you issue a treasury bill of 7%, that means you're technically making a profit of 3% out of that. So any lending to productive sector is not bad.
Okay. I get your point there that it makes sense to lend where there is actually productivity. But it seems as though if you look at the structure, there's actually been an inclination towards recurrent expenditure, which then has led many people to ask many questions.
Yeah, but in the context of Zamco, it's not money that was redirected to recurrent expenditure. This is expenditure which is capital in nature. It's actually meant to boost these companies. I think the question really is, was there a due diligence done on the companies that were funded? I think I would want to agree to some extent that some of the companies don't have proper structures to actually produce a profit position. If you look at some of the problems at Wange, those are purely to do with governments meddling in terms of contracts and whatnot. So some of those companies remain a challenge, they remain on an overhang. And I also don't seem to appreciate the way that NPOs have also started moving back again. Those same people that were bailed out might now be going back to the same banks, and they are also now thinking, you'd have set a bad precedent. We can take the money and get away with it.
There's an easy way out.
Yeah.
Okay. Then another issue, Dr. Mangwijka defended the bond notes as an incentive for exports. But let's have a quick look at the stats, because from the figures here, this is the Zimbabwe external trade position right up until December 2018, coming from November 2017. If you have a look at the stats, there is no discernible growth pattern on a month-to-month basis, and as far as the exports, of course, the exports are the ones in green and the imports in red. But if we look at the growth of, there is no discernible position that perhaps proves that the bond notes have actually worked as a export incentive.
Yeah, I think it's wrong for us to rely on a month-on-month data covering a period of just 13 months. Bond notes were introduced in November of 2016, right? So we should have a December, or we should have a December 20. So we're coming from what? It's December 2016 up to date. If we look at the growth in terms of exports, the growth is now, between that period and now, the growth is over 50%. So if we rely on month, we might not get a proper perspective in terms of how exports have grown. But I think what's fundamental is to look at what composes of that growth, what inspired growth in our exports. So I think it's important to look at the mechanics around that. What I believe, if you look at the nature of our exports are mainly mineral dominated. 30%, 28% is gold. Tobacco is slightly 11-12% thereabout. And so these are the dominant minerals. And if you look at global markets per se over the past 3 years, some of these minerals have been gaining in value. And so there is an aspect of price recovery in international markets, which is number one, which is independent of Zimbabwe's own efforts. And if you look at players such as Zimplats and whatnot, these are guys who had put in their own investments independent of government, to try to...
Are you suggesting that the bond note has been successful as a currency? I mean...
not as a currency, as an export incentive. I think that's where we are. We are saying, did it succeed as an export incentive? That maybe we can get back there. Exports have been growing, but is it due to bond notes? That's what we have to look at. So initially, this was 10%. This was 10% on top of the money that you earn from your gold sales. So they would take a fraction of it and give you back that money as an export incentive. But now, the success or failure of it can best be read at a period October 2018 up to December. What happens? We see a sharp plunge in the local exchange rate. And that sharp plunge, given that you are selling, your dollars are being taken by Arabs at 1:1, we saw a drastic plunge in terms of exports or in terms of deliveries of gold, which essentially means exports of that particular product went down. And this is true of all other minerals, given that most of these would still be taken for 1:1. So what happens? Why the decline if the export incentive is there? Is because the rate at which the local currency is depreciating is far much worse than the gain that's accrued from an export incentive. So if the export incentive could counter the decline in exchange rate, then we could say that it's working. But how or what justifies you matching the export incentive to the decline in currency? It means you have to print money, and yet bond notes were just kept at 500 million.
Right.
So they couldn't do that. Number two, was bond not a bad? Was it as bad?
Yeah, definitely so. Let's look at October. October, in the MPS, Dr. Mangujiga says there's now parity between the bond and the US dollars, which we knew very well that it was not going to work. And look at the cost that it has had on Zimbabwe, with the central bank governor just more than a week ago claiming to be guilty as charged. And Professor Mtuli Mncube says that this whole 1:1 has cost Zimbabwe over $1 billion in as far as revenue is concerned. So if we then...
I think from my view, I don't think that bond notes were totally off rails. What was wrong was to introduce the note at a time when it was discernible that money supply was starting to grow at a faster rate. Bond notes are kept at 500 million. We have a banking sector which by then, in 2016, was at 6 billion. So you have 500 million at max at that point. At max now, at that point, it was still around 100 and so forth million in the system against 6 billion. And that definitely had no impact on money supply, because it was just some basic level in terms of quantum. So the goodness, or the one good thing about the bond note then, which I believe Mangujiga had done well, was to peg the rate at which he releases bond notes to production. One rule in money supply in economics is that you cannot increase your money supply if your production is not growing at a similar or faster pace. The challenges that we are having in Zimbabwe right now is we are having a faster growth in money supply, which cannot be matched by the growth in production. So what happens? We have a huge RTGS balance, but we don't have goods in the shops. Why don't we have goods? Because these goods needs a forex, partly forex, in order to produce finished goods. So what Mangujiga had done was to say, let me create a currency which I can only increase at the pace at which my forex, my produce and forex earnings is also increasing. You only export, then I give you. And when you export, you're exporting a full product and you're earning me US dollars. So there's no problem in matching your money growth with the growth in exports.
Okay.
But his problem was he assumed that the world of Zimbabwe's economics is fixed around monetary leg, which was wrong. If you could have looked at the fiscus leg, he could have seen that the rate at which government was borrowing, the rate at which government borrowing had an overall impact on money supply would make his money also bad money. So every Zim money would become bad money, and assuming parity would always be difficult to maintain. So bond note was defeated together with the RTGS, not for its own weakness, but for the weakness of its sister, which is the RTGS. And you could not vary the value between the two, because they are related, they are all local units of exchange. So that defined the death of... but what has spared Mahungujika up to this day is because government appreciates that it was purely not his problem. This is purely a fiscus problem which led to a growth in money supply. And his currency is found there among the bad money. That's why his job was spared up to this day. So any money supply growth should be accompanied by a growth in production in order for it not to be inflationary. And when you keep parity, it means the exchange rate can be kept at parity. So his economics was okay, but it had no foresight because it was limited to the monetary side of things.
Well,
That's my take.
Okay, well, quite insightful there, Respect. Thank you, Respect. Up next is Anesu Chimbumu with a view on the markets. Welcome back, Anesu. Good evening and welcome to the show.
Hi, Eben. How are you doing today?
Fantastic. Can only get better. Yourself?
I'm alright, my man.
Beautiful. Please take us through the stock market.
Alright, today was a damp day again, except for one index among the four indexes on the stock exchange. We had the mining index coming up today after about 5 sessions being stable, coming up 2.97% for it to settle at 213.17 points. Now, the all share and industrials index did come off 1.25% and 1.32%. Now, this is also on the back that these indices actually had taken a breather from about a 4-day onslaught of a recession coming into Friday, where it took an uptick right there, and then we then opened this week on a very bad note. Now, of the top 10 index, we realized a 1.16% loss, settling at 143.78 points, with 7 counters in that index coming off. The biggest mover for today was actually Old Mutual in the top 10 index. Old Mutual came off about 6.8%, bringing it back 12.09% on a year-to-date basis. Now, we do realize that these losses have recently been occurring, much to do with the MPS being released, and then with the foreign exchange rate being relaxed, and also having some free play in the foreign exchange market for all Zimbabweans. Now, with that being said, we do realize that there has been some sort of uncertainty among investors, and some investors do feel that they may have a play at the foreign currency market now that they don't have to, that they do have a chance to get better profits or better returns in the foreign currency market as opposed to the stock exchange. With that being said, today we actually had about 23 counters that exchanged hands. 11 of those 23 counters were bears and only 3 were bulls. Of those 11, the worst performing counter of the day was Hippo, that came off 19.3% for it to settle at 138 cents, while Deribot lost 6.89% of its previous share price to settle at 14.6 cents. Willdale was the better performing counter of the day, adding about 15.33% for it to settle at 1.73%. Like I mentioned earlier on, that we do realize that there was an uptick on Friday, which is pretty much graphically represented around about this area, where we have that slight notch right there. But then overall on the 5-day trend, these indices are pretty much down 3.57% and 3.58% for the all share and the industrials index, showing a pretty much damp week, once again making it the 5th straight week in losses for the stock exchange.
Well, so what can you expect going forward? Of particular interest to me would be how the mining's index seems to be playing differently to all the other indices that we've got. All the other ones are in the negative, but it seems to be on a positive. Well,
the mining's index, like I mentioned earlier on, that there is a weight here, a counter within that index, which is Bindura Nickel. Bindura had a fairly good day today, had a good number of trades that happened on that counter. So this could have pretty much influenced for that rise in the mining's index for the day. But as you can see that we've had somewhat of a stable and somewhat stable situation for the last 2 trading sessions after the index came off a couple of points in the previous week. Yes.
Well, that's about it for tonight. Thank you, Anesu, and thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website www.equityaccess.net. Good evening.